Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us for the second segment today. We're talking a little bit about alternatives for income investing, and we just prefaced it last segment. If you missed the segment, head on over to our website, www.dlblain.com. We'll post archives copy of the show there in a week or so. You can catch up. But first of all, we don't advocate chasing yield. And by chasing yield, what we mean is looking at the income that investment pays, 2%, 5%, 7%, and picking your investments based on the yield. And the reason is, it's very simple. The higher something is yielding, the more risk that it entails. I'm still amazed, people today, the notion that they say, oh, well, I found this investment that's paying, 7, 8%, and the U.S. Treasury is paying 2%. I found this bargain. I found this thing. I'm the only person that knows about it. I'm getting over on everyone else. That's just completely ridiculous in today's world with literally billions of people investing, to think that you have come across some great investment sitting in your house all on your own. It's just not going to happen. Now, yes, that investment may be paying a higher yield and it may work out just fine. But the reality is that in order to get that higher yield, something has to be different. Some sort of risk must be involved with that you may be aware of, and you may accept that risk. But the notion that you could just go out and get 6, 7% yield and not add some additional type of risk to your portfolio, it just does not exist. I'm not a big, I think there are some issues with what we call the efficient market hypothesis, but the reality is that prices across stock markets, bond markets, generally do a very good job the majority of the time reflecting all available information about the market prices. Now, if new information comes out, then the prices are going to react to that. But trying to know that information ahead of time is almost impossible. People that have the appearance of being able to do that generally are lucky. We talked about this last week about Marty Zweig, who called the crash of '87. Well, anyway, we'll get kind of off topic here. So let's start with one of the first categories is what is high yield bonds. People go out and they invest in high yield bonds. They look at a company that may be in distress. Wall Street has another name for these bonds. They're called junk bonds. So high yield bonds, the people that are trying to sell them came up with the term high yield bonds, but on the street, so to speak, they're called junk bonds. And so if junk bonds is something that you want to invest in, well, fine. And in certain circumstances, once again, as long as you know what you're getting into, but high yield bonds generally correlate more with the equity market than the bond market. And our theory on high yield bonds, if you're going to take that type of risk, go ahead and take it on the equity side of the market where you're more likely to get a return commensurate with that risk. So what are junk bonds? Junk bonds are lower rated bonds. These are bonds issued by companies. Well, by the way, let's back up. What is a bond? A bond is when a company or governmental entity goes out to the investment marketplace and it says, please lend us some money, and in return we promise to pay you your principal back at a certain point in the future, and along the way we'll pay you an interest rate. So when the U.S. government goes to the bond market, they say, look, we need some money to pay for all these government programs and pay the congressman and senator. We need some money. So they go out to the world and they say, look, we will offer a 10-year bond. So you loan us your money for 10 years. In return, we will pay you 2.5% interest for those 10 years. And at the end of the 10 years, we'll give you your money back. Well, corporations do the same thing. So high yield bonds are bonds issued by companies with less than stellar credit. If you think about a credit, everybody has a credit score. And, if you have an 800 or above credit score, you're going to be able to borrow money at a very low rate. Well, corporations and governments have credit scores as well. And when they go to the marketplace to borrow money, this credit score dictates the interest rate that they have to pay. So if you're Stockton, California, which went bankrupt, and you want to go borrow money from the marketplace, you're going to have to be willing to pay, 10, 12%. If you're the U.S. government still today, you only have to pay 1 or 2% to your investors. So high yield bonds are those bonds issued by companies and governments with less than stellar credit. So they have to offer a higher interest rate to attract the capital. Now, if you're using a high yield bond fund or ETF or something like that, you're diversifying your risk across numerous bonds, so the risk of any one particular one defaulting goes down. If you're out there buying individual high yield bonds, that's really, in my opinion, a mistake. That you have no diversification, the likelihood of default. We see historically the average default on high yield bonds is somewhere around 5%. As we enter into recessions and periods like that, we see the default rate go up into the 12, maybe 15% range. So when you go out and you invest in a high yield bond, what are you getting paid for? You're getting paid for the risk that that investment goes to zero. And we've seen some studies over the years done by other firms that the return on high yield bonds over long periods of time is not significantly higher than that of investment quality bonds. And so there's some question as to whether the investor is being adequately compensated for that risk. Once again, we think that the high yield bonds that correlate more with the equity market and they're best used as a substitute for equity and not really in the safe bond portion of the portfolio. Okay, the next one we hear about, preferred stocks. And we actually bought some preferred stocks back in the depths of the recession in 2008 because they were selling so cheap. But the reality is preferred stocks are not a substitute for bonds either. Preferred stock are issued by companies. They rank in the capital structure a little bit above common stock but below bondholders. And in return, they offer to pay a much higher rate of interest. And so they're a hybrid between a stock and a bond. They have a lot of unique features that people may not understand how they work. The other thing is they tend to be concentrated in the financial industry. We're coming up on our second break. When we come back, we'll continue talking about alternatives for income, alternatives to the bond market for income, and if they're a good idea or not.